Hello and welcome to Asset Reboot 2017. Now, the year gone by was full of twists and turns and peak and turfs. Locally and globally, the environment has got rebooted. But what kind of impact it will have on asset allocation? The way world would be doing business in 2017 would be radically different, both locally and globally. At a time when interest rates are falling, there is a lot of volatility in equities. Gold and real estate is unlikely to give a superior return. How should an average Indian save and invest? That's a $1 billion question. And to answer that, I have with me the perfect guest, someone who champions asset allocation, Karan Bhagat of IIFL Wealth. Fantastic to have you on ET now.
Thanks, Nikunj.
This is your first time on ET now, so very warm welcome.
Thank you.
It's been a big reboot both locally and globally. Globally, it's politics, locally, it's demonetization. And this reboot will force Indians to save differently and invest differently.
Right. Well, I think 2 or 3 big changes which have happened in the year gone by. I think for the first, interest rates have come down by at least 150, 200 basis points. An average Indian investor was well content with the fact that he could come into risk-free asset classes and get around about 7.5%, 8%. With a tax conducive environment, if he was investing for 3 years plus, he could potentially make close to 8% on a post-tax basis. Now with interest rates close to risk-free return being close to 6.25, 6.5, it's extremely difficult for any investor to end up at close to double-digit returns on the portfolios without having at least a 40 to 50% allocation to equities. So it's a good challenging environment both for clients as well as wealth managers like us, where we need to kind of, in your terms, reboot the client's portfolio to kind of engineer back a double-digit return. Equities itself for the last 2 years have been flattish. Good actively managed portfolios have done better. They've possibly been able to do the double-digit return in spite of the markets being flattish. But I think it's a good time with environment looking slightly better over the next 2 years, and I think earnings growth set out to be 10 to 15% next year. I think it might be a good time over the next 3 to 6 months for investors to also kind of increase some allocation to equities.
So I'll talk about first all asset classes, and then we'll get into what are you recommending within those asset classes. Now, first let's talk about fixed income. The bulk of your portfolio, your client money is in fixed income. Last 2-3 years have been very good for fixed income because interest rates have come down in a linear manner.
Right.
That may not be the story this year.
For sure.
So what happens there?
So I think fixed income is broken up into 2 key parts. One is what we call as the hold to maturity portfolios, which are more of the kinds of fixed maturity plans or the tax-free bonds. And second is more the mark to market, which is kind of moves up or down depending on the view of the interest rates. So I think the first bucket, which is the hold to maturity bucket, is kind of been locked in by investors over the last 2-3 years. So I think that problem might not erupt this year because most of them have locked in for the 8.5, 9% returns, at least for another year and a half down the line. But when that money comes out, that will also be a big issue because at that point of time, the reinvestment risk will be quite high. In terms of the mark-to-market portfolios, I think overall we've kind of moved the allocation from overweight to neutral. So like you rightly said, we don't expect rates to continue going sliding down. I think at some point rates will settle. We don't see too much of flexibility with the regulator also to continue to decrease rates. It's possible it might come off 25 to 50 basis points over the next 18 to 24 months. But for it to happen in a hurry, especially with Fed indicating towards 2 or 3 hikes, which also may or may not happen. But we are definitely not going to be in a massively declining interest rate environment. Therefore, to make massive mark-to-market gains on a bond portfolio is unlikely. And therefore, I think overall your fixed income allocation will be underweight to neutral, at least for the next 2 years. And I think a benchmark return, if you end up at close to around about 7%, is something which you should be happy to walk away with without taking any credit risk. So I think in fixed income itself, an average Indian investor doesn't take any credit risk. 90% of our portfolios are AA plus to AAA. And honestly, in India, there's practically zero history of a default of any AA plus paper to AAA papers. Now, if we stick to this philosophy, I think the return range will end up unfortunately being in the bucket of that 7 to 7.5 or 7.75. So as investors and wealth managers, we'll have to look either beyond fixed income or beyond AA plus in fixed income to try and generate incremental returns.
But when you talk to your clients, are they understanding that they need to buy risk now?
For sure, I think every client understands that he needs to buy risk, and it's something which I think is still being understood. It's not being practiced in full because of two reasons. I think one, because clients have had the fortune of at least being able to lock in returns for the last 2 years and possibly for the next 1 year already in fixed income. And second, I think there's been massive amount of uncertainty. I won't call it skepticism, but uncertainty around what's happened over the last 3 to 4 months, which is, I think everybody's hopeful, everybody believes it's the right step, but people want to see how fast the economy recovers and how fast does the uncertainty go away before committing large amounts of capital to risk. So I think the overall mood is positive, sentiment is positive, but has the actual allocation to risk assets started? The answer is possibly not a big yes yet, but it's in the process of making a beginning. And as you rightly said, honestly, all of us don't have a choice beyond a point of time. If we need that 9 to 10% return and we need to beat inflation, we'll have to take a bit of risk in our portfolio and increase our allocation to equities, for example.
So are we looking at a real tsunami of local money coming back to markets?
I think it's an interesting question. If you see for the last 3 months also, our markets have kind of been totally supported by domestic flows. If I'm not wrong, I think the FI flows for the last 3 months are net 25,000 crores negative, right? And domestic flows obviously are buoyed, very, very buoyant, mainly driven by inflows into mutual funds. And inflows into mutual funds also can be very nicely broken into 3 categories, if I can. One is basically the flow into SIPs. Second is retail money, and third would be high net worth money. And the breakup of these 3 is also extremely interesting because the most buoyant and the strongest has been the SIP flow, which on an average, I think for the last 3 months would have averaged 3.5, 4,000 crores of net flows a month, which is extremely, extremely strong. And as a market, if you can see 35, 40,000, 50,000 crores of SIP flows every year, it'll be a huge, huge kind of backbone spinal support to the market, which has been kind of missing for the last decade or so. Second, retail participation has also been positive over the last 3 odd months. High net worth money, though not seen evidence that much in the mutual fund space over the last 3 months, has found its way either through portfolio management schemes or alternative investment funds more as compared to mutual funds, but has slowly and in small ways also creeped in the last 3 months. So overall, I think domestic investors have been much more buoyant about the Indian equity markets as compared to the FIs over the last 3 months. And therefore, to a large extent, yes, last 3 months, the support of the market is driven more by domestic investors. To answer your question, will it stay the next year? I think the answer is yes. I don't see the SIP flows reducing at all. High net worth money will move from fixed income to equity for sure. A lot of the money which was earlier in, if I can use, for the lack of a better word, in an informal lending market, where essentially, in the form of ICDs and so on and so forth, intercorporate deposits will also now move back into the formal market, and it will find itself very difficult to find a home in a fixed income security of 7.5%, and therefore will slowly but surely move into asset classes like equities. So those flows also can't be kind of ignored. And as long as the secondary order impact on consumption is not massive because of demonetization, I think the flows into equities will be very, very meaningful.
Are your clients happy with 9% and are they very unhappy with 7%?
So I think it's a good question. I think we'll need to take a step back as to why clients invest. Okay, I think again, there is a retail client, there's a mass affluent client, and there's a real high net worth client, right? I think the objectives of investment for all 3 are slightly different. I think a retail client still comes in with some degree of desire or want to multiply his money or get disproportionate returns. When I say disproportionate returns, I'm talking about the 12 to 18% kind of post-tax returns on his money, for which he is willing to possibly take some degree of risk. As a high net worth client, the larger your net worth, investing money starts becoming more and more about wealth management and capital preservation as opposed to wealth creation.
It's always the other way. The retail guy takes more risk, the HNI never takes the risk.
Actually, it's to do the mindset, right? So in some degrees, you've taken a conscious call that the business you're doing is where you're creating wealth and where you're doing your investments. You want the volatility to be low. You want to preserve wealth, but definitely beat inflation. So I think if you have a large quantum of wealth, somewhere that 9 to 10% post-tax is the right number you'll be aiming at. And in your own business, you'll look at an ROE of 16 to 20%, because if risk-free is at 6.5, 7, in your own business, you'll want at least a return of 14, 15% post-tax at the minimum, because that's where you're putting in your hours, you're putting in the labor, and you're taking risk. But from an investment or money perspective, as long as the volatility can be managed, then I think around about that 10% number is good. And to be honest, if I ask a lot of my clients, let's say if you have a pot of money, let's say 50 crores, just for an example, if you ask him, are you happy if this 50 becomes 100 post-tax in 6 years? I think, or let's say 7 years, I think 90% clients will say yes. Reality is 50 becoming 100 in 7 years is a return of 10% per year, okay? But how many people are actually able to grow the full portfolio at 10% post-tax every year? It's also sometimes a big challenge. So actually the art is in A, reducing the volatility so that you can stay invested for 7 years. B, ensuring a 10% return on your full portfolio, which means fixed income at 7.5, 8, equity at 14, 15 will get you to the weighted average of 10. And third, on a post-tax basis, because somewhere down the line, your tax rate, average tax rate ends up being in the region of 7.5, 8, 10%. So you need nearly 11% pre-tax. So on a consistent basis, to get around about 11% pre-tax on your portfolio for a long period of time, I think you would have done well. Our friend Mr. Buffett over the last 35 years has done whatever, I think 14% in dollar terms, which effectively in rupee terms is close to 18.5, 19, 20%, which is a massive return, right? And he's invested across the world. I think if you can do somewhere close to 60, 65% of that, we would have done extremely well. And obviously, we can't benchmark ourselves to the Indian Buffetts, because obviously they're the risk-taking appetite, and for them it's a business. They're really studying the stock and kind of getting into it. So I think from a high net worth client perspective, a good asset allocation with lesser amount of volatility and ability to stay invested over a longer time period and earn the 10-11% is more or less the right benchmark to expect.
Do you think real estate and gold, two important asset classes where Indians, they save and they park a lot of wealth, would be forgotten asset classes for next 12-18 months?
See, real estate is a very funny asset class in my mind, right? Because of 2 or 3 simple reasons. One, obviously we've got 2 classes of real estate, residential and commercial. Now very simple economics, and I'm sure everybody's aware of it. If you just see where we are sitting, which is Lower Parel and most of the area around it, I think the supply is tremendously high, right? Or if I just start looking from Prabhadevi all the way to Mahalakshmi, the kind of supply which is there, I don't know how it will get consumed and over what time period it will get consumed. Second, I think real estate is quoting at nearly, if I include the interest cost on the money which we are paying, whether it's the 10, 20, 30, 40%, is quoting at nearly 1.5 to 2 times replacement cost. When I say replacement cost today, if I just take the value of land plus the cost of building the apartment, today we are paying nearly 2 times the replacement cost on residential, with the yield being around about 1.5, 2%. Okay, it just doesn't make economic sense for an asset to be valued at 2 times replacement cost with an yield of 1.5, 2%. On the flip side, commercial assets are quoting at close to 1 time replacement cost in most cases, and the yields are in the region of 7.5, 8%, right? So it's either of the assets are extremely mispriced, right? Because you can't have one asset at 1 time replacement cost with an 8% yield, and the other asset at a 2 times replacement cost with a 1.5, 2% yield. So at some point, this paradigm will kind of need to get broken.
Do you think commercial to come down?
I think commercial will go up. I think commercial will go up and residential will come down, because the bridge is way too far. And in terms of monetization of commercial assets, if REITs actually comes through over the next 2-3 years, I think it will be an excellent opportunity to get it monetized, and that's where some bit of retail money can get in, and therefore there is that window for commercial assets to get repriced in that sense, and residential assets to possibly both because of supply and I think artificial inflation in price. I think both those reasons will lead it to more or less stagnate. See, in residential prices also, when we talk, there's no price correction.
Yes.
It's a myth, right? Because 8 years back also, more or let's say 5 years back, just to take Lower Parel in Bombay as an example, it was more or less quoting at the same price. We just spoke about risk-free return being at 7.5-8% over the last 5 years, which is on a compounded basis 50%. So value of your property is down by 50% over the last 5 years in any case, even if it is just the same price as what it was 5 years. And you've got the 1.5% yield which you would have paid otherwise to stay in it. So effectively still down 40%. So in that sense, I think you'll continue to see a massive time correction in residential property, even if you don't see a steep price correction. I think commercial will stay flat, and once eventually business activity picks up, which it has started already over the last 6 months, then supply and commercial will be lower than the demand, and that's when you'll actually see prices kind of move up. So I think commercial price still 12 to 18 months to move up, but definitely within real estate a better asset class to bet on. If you were to take equity exposure, if you were to take debt exposure in terms of if you have to take residential exposure, then we would prefer to be lenders as opposed to being buyers. So in terms of the two asset classes, I think commercial we will be willing to take equity participation. On residential, we will be more inclined to take fixed income participation, because our belief is to get more than 15 to 16% return on by taking equity participation in residential real estate today is not going to be possible. So we're better to be on the fixed income side on residential, and commercial we might be willing to take some bit of equity exposure, because we believe there are enough events of monetization also through REITs over the next 3 to 4 years.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.